It's the age-old saying, it's not about timing the market, but time in the market. The concept of long-term investing often gets thrown around by financial professionals when times are tough, when markets are down. Let's go and test that concept. And hey, if you don't believe me, stick around till the end of the video and hear what world-famous investor Warren Buffett has to say about this. Welcome to the pursuit of moneyness. I'm your host, Marnus Mostert. Timing the market refers to the philosophy of buying low and selling high at exactly the right time. I've just got one question. Who's going to ring the bell? Who's going to be the indicator to tell you when to buy low and when to sell high? Who knows if the market is truly at the lowest lows or the highest of highs? Let me tell you, nobody. Let's look at an example of this and form a little bit of a scenario story between two friends called David and Bryan having a drink at their favorite local pub. As one drink turned into two, and two into three, and three into four, David and Bryan broke one of the most crucial rules in a pub. Never ever talk about finances. David mentioned that 15 years ago on 1 April 2005, he had accumulated 1.5 million rand in an investment. He also decided to contribute 1,000 rand on a monthly basis towards that investment. Now, David was a very hard worker. He never liked if his investments depreciated. Hence, he took the decision to invest everything in a money market, cash, so to speak. Over the period, meaning up until the 1st of April 2020, money market or cash itself returned 196%, with no volatility, no ups and downs, smooth sailing as they would say. His investment now sits on 4.7 million rand. At the same stage, Bryan, already grey from all the market turmoil in the last 15 years, invested his 1.5 million in the JSE. He received a return of 407%, and his fund value is just over 7.9 million. The friends look at one another, wondering why their scenario looks so different, but they both had the same capital and contributions. I mean, 213% more. And in actual fact, Bryan had just north of 10 million rand just before the coronavirus hit. David just couldn't understand how Bryan's investment on the JSE survived the 2007 and 8 global financial crisis, 2015 Nenegate, 2016 Trump's presidential election, 2019 the trade war, and finally, last but definitely not least, the 2020 coronavirus. Now, although David's investment was protected and sheltered against all these events, Bryan still came out on top. I believe he did three things right. Number one, he never touched or changed his investment. Number two, remember that monthly contribution Bryan had? Every time the market fell, he was buying more shares at a discounted rate. Number three, Bryan reinvested all his dividends. Now, not to get too overcomplicated here, but if you are invested in the JSE, in essence equity, you are automatically a shareholder in various companies, and companies pay shareholders dividends, either on a quarterly, annual basis. It doesn't matter. The point is, Bryan reinvested all those dividends. Both the effect of investing on a monthly basis and reinvesting dividends as the market fell had a compounding effect towards Bryan's success over David. However, I understand that the market is not for everybody. If you still feel a bit risk averse, you have the option of investing in a balance fund. Now, essentially a balance fund is a mixture between equity, property, bonds, and cash, both local and offshore. The asset manager that manages the balance fund will also rebalance the portfolio from time to time, which will enable you to feel the effect of selling high and buying low done for you by the institution. The example on screen is the amount of equity a very renowned balance fund in South Africa had in the last 10 years. The manager could consequently sell shares that they see as a high price and trade them in for, so to speak, shares trading at a lower price. This allows them to maximize the effect of a reaction in the market, whether it be up or down. The advantage is these decisions do not lie in your hands as the investor. The problem if investors try to do this themselves is really because they act on emotion when doing so. They either buy at a high point due to greed or sell at a low point due to fear. A lesson to be learned here is to stick to your plan. But in the bigger picture though, if you want to avoid fear and greed driving your decisions, develop a robust financial plan and stick to it, whether it be investing in a balanced fund or the markets. I promise you today, if you understand what you own and why you own it, you will be much less likely to panic in times of turmoil. But hey, if you don't believe me, hear what Warren Buffett has to say in this CNBC interview about markets and timing the market and the concept of long-term investing.
I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt that it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
You know, I know you look at things like that, but I also know that you look at stocks and try to decide if they're fairly valued, if they're overvalued, if they're looking cheap at this point. And we have been waiting for a correction for an awfully long time. That's finally come. Do stocks look cheaper to you, just based on where we've come?
Well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. But you know, stocks are going to go down. You could probably look it up as to what percent of the days, since I was born, they've gone down, and maybe it'd be 30% or something like that. And you can't predict what stocks will do, but in the short run. But you can predict that American business will do well over time. And just take the 20th century. Stocks went from 66, the Dow average, 66 to 11,497, and you were getting 3 times as much in dividends as the whole average was selling for at the start. And you had 2 world wars, and you had a Great Depression, flu epidemics, all kinds of things. American business will do fine over time, and if you own a piece of it, and if you don't beat yourself, the only person that can cause you to get a bad result in stocks is yourself.
Welcome back, and if you enjoyed that clip, please remember to like my video and subscribe for future videos. But it is as clear as daylight that Warren Buffett invests for the long term. Not only that, he actually prefers the markets going down from time to time. Much like Bryan, it enables him to buy shares at a discounted rate. But my advice to you is to seek the help of a financial advisor. He will be able to take factors such as your age, your current circumstances, your goal, your risk appetite, everything into one and develop a robust financial plan that you need. Are you worried about your retirement fund or investment? Well, great. In my next video, I will be discussing tips and tricks and the strategies you should be using in order to maximize your investments. Please remember to like this video, and also, most importantly, remember to subscribe to this button on my left, your right. Thank you for joining me for another edition of The Pursuit of Moneyness.